Greetings from India. You are listening to the Businesstalk podcast. I'm Deepak, your host for today's episode. We are delighted to welcome Professor Angel Zhong, Director of Research, Regenerative Futures Institute, and Professor of Finance at RMIT University, Australia, as our esteemed guest on today's podcast episode. Professor Zhong is an award-winning finance academic specializing in empirical asset pricing, digital finance, global markets, investor behavior, and emerging trends in retail investing. She serves on the editorial boards of Journal of Accounting Literature, Finance Research Letters, and Journal of International Financial Market Institutions and Money. Her research, which has attracted over $600,000 in external funding, combines academic rigor with practical investment applications and has gained international media attention. Professor Zhong is committed to improving financial literacy and well-being in Australia and has been recognized as a finalist for the Women in Finance Awards in 2021 and 2023 and as a LinkedIn top voice. She collaborates widely with industry partners including Capital Network, Refinative, Page Executive, EIM Executive Interim Management, and Northern Trust Assets Management, translating research into actionable insights for finance professionals and students alike. In this episode, Professor Angel Zhong dwells into her research, Retail Investing Revolution, what's fueling the rise and where it's headed, offering fascinating insights into the forces shaping the modern investing landscape and what the future may hold. So, without further delay, let's welcome Professor Angel Zhong to the podcast. Professor Zhong, it's been a true privilege to host you today. Thank you for taking the time to join us and discuss your work.
Oh, thank you so much. It's a pleasure to be here. Retail investing is one of the, I guess, most exciting areas in finance right now, and I'm really thrilled for this opportunity to share insights from my research and experience.
Thank you. Professor, can you start by defining what we mean by retail investing in today's digital era and how it differs from institutional investing?
Of course. When we talk about retail investing, we sometimes will also refer them to, for example, things like individual investing, or they're also mom and dad investors because they're just normal persons, individuals like us, investing our own money, typically through online platforms and apps. Unlike institutional investors such as pension funds, hedge funds, or other kinds of managed funds, retail investors tend to have a smaller amount of capital, shorter investment horizons, and they're more likely to be influenced by their emotions and the trends in the market. I also think that the digital era has democratized access to investing, allowing anyone with a smartphone to participate in the market, which is a major shift in the past.
Professor, your research highlights the behavioral pattern of retail investors. What are the most surprising trends you have observed in the decision making and risk appetite?
Mm. Yeah, that is what I am always passionate about. And one of the most surprising trends is the rise in risk appetite among younger investors. I think many of them they are drawn to volatile assets such as crypto or meme stocks, which is also driven by social media hype and also a desire to get rich quickly. And the other one is herding behavior, or what we refer to as social trading, whereby retail investors they follow the crowd without conducting due diligence. That means they just do what the others are doing on social media forums. But we also see a growing segment of retail investors who are also highly informed, and they use data-driven strategies, which is encouraging. And they also deeply appreciate the idea of financial freedom and financial empowerment because they view investing not just as a way to grow wealth, but also as a path to independence and to take control over their financial future. So this emotional and psychological dimension is often overlooked, but it is a powerful motivator behind the retail investing revolution.
Professor Zhong, how have digital platforms, social media, and commission free trading apps transformed retail investor participation over the past decade?
Hmm. Well, really interesting question, and that has been I guess, one of the greatest development in the past few years because these tools they have lowered the barriers to entry. In the United States and in a lot of countries, you've got fee-free trading apps such as Robinhood, and there are platforms such as eToro that have made investing accessible and gamified. And then we have social media platforms such as Reddit, Instagram, TikTok, Facebook, and YouTube that have become a source of financial advice, for better or worse. This has led to a more engaged, but at the same time, more emotionally driven investor base. And related to my research, one of the most interesting development, I guess, is the rise of influencers. As we know, what are influencers? Influencers are those who are very popular on social media platforms, producing content, and they have a large group of followers. When it comes to influencers, I'm talking about those influencers giving free financial advice, investing tips, and personal finance advice on social media platforms such as Instagram, YouTube, and TikTok. Well, I would say that some of them they do offer very valuable education, but many of them actually lack formal training and they tend to promote speculative and dangerous trading behavior because they are very engaging. Um, they can explain finance concept in a very simple manner. They actually exert a significant influence on retail investors, especially among those who are young and inexperienced. So which is why I always think that there is a strong need for financial literacy and education. But I guess we'll touch on that for some of the other areas.
Professor, many argue that retail investors contribute to market volatility. Based on your empirical findings, how significant is their impact on asset pricing and short-term market swings?
Mm. Well, yeah, that is exactly one of my research areas. So, for example, I've published several papers that actually looked into retail trading during COVID-19 around the world, as well as with a specific focus on the Australian equity market, because I'm based in Australia. So what I find is that retail investors, their trading, especially during crisis period, their trading provides a lot of liquidity into the market when we were in crisis. However, because of the irrational trading, it also amplified the short-term volatility. So a good example is the GameStop trading saga back in 2022. And also the overall impact on long-term asset pricing is actually more complicated. Well, they're not the sole drivers of volatility, but they do play a significant role in short-term volatility.
Meme stocks, social media driven rallies, and crypto booms are often cited as a hallmark of the retail investing revolution. How should regulators respond to these phenomena without stifling innovation?
Mm. Yeah, that is something that that has always drove in my mind. What should regulators do? And what should we as academics do? What First, I think regulators here they're facing a really delicate balance because on one hand, their job is to protect investors from misinformation, as well as those what we call the pump and dump schemes orchestrated by perhaps some dodgy social media influencers. But on the other hand, you don't want to be too stringent so that you actually deter innovation, which is why I actually advocate for smart regulation. So it is a combination of enhancing transparency, improving financial literacy, and also ensuring that these trading platforms, as well as social media platforms, they have safeguard. And remember, we talked about the popularity of influencers. One of the reasons that influencers are so popular is because um, a lot of young investors they are really hungry for financial knowledge, but they're not really equipped with financial knowledge, which is why I always think that no matter which country we are in, education financial education is always key. Informed investors are less likely to fall prey to hype. Um, it's exactly because of the lack of financial literacy. It actually create a vacuum or a loophole for influencers to fill. Sometimes they do it in a responsible manner, but many of them are very dodgy. For example, they understand that they have a large group of followers. So what they do is that they actually recommend financial products, and they receive commissions or kickbacks, but they're not disclosing this conflict of interest. So it can potentially mislead whoever is watching their contents and actually then act upon the advice. So I guess to address this issue, it's very essential to improve financial literacy, and also to make financial education more accessible because it can then empower individuals to make informed decisions and to reduce their reliance on potentially misleading online content. But that is a problem that would require a long-term solution because even for where I am in Australia, as at high school, primary school, we don't really have a standalone financial literacy curricula. So I really think that financial education in a systematic manner is the elephant in the room that governments and regulators around the world will need to address.
Professor, in your view, is the rise of retail investors reshaping traditional financial market hierarchies, or is their influence overstated in broader market terms?
Yeah, I think that retail investors they are certainly more visible and more influential than before. They've challenged traditional norms because we tend to think that retail investors are not powerful, but what happened during the GameStop saga actually challenged that traditional view that retail investors can't move the market. But of course, due to the amount of capital and their influence, institutional investors still dominate in most of the market. But the retail revolution is actually reshaping this whole narrative, but not yet the hierarchy. Because I don't think we have the tools and education to really change this dominance of institutional investors. And I guess what is driving this shift is not just the access to the markets, but it is a deeper desire among individual investors, especially the younger ones, for agency and voice in financial systems that historically excluded them. Many, as I discussed before, a lot of investors, especially the young ones, they see investing as a way towards financial freedom and independence. It is also a way to participate in economic decision making, if they can influence corporate behavior and also to voice their values. So this democratizing force is actually subtle but really powerful, and it is indeed pushing traditional institutions to rethink how they actually engage with institutional investors.
Professor Zhong, behavioral biases like herding and overconfidence are often discussed in retail investing. How can
Mm.
individual investors recognize and mitigate these tendencies?
Mm. Really interesting question. And behavioral finance, or the study of investor behavior, is what keeps me always passionate about, being a researcher because I always think that even though I study a lot of the price movement, volatility in the market, but the most interesting aspect in the market is actually human, which is why some of my research papers actually focus on investor behavior and how that investor behavior then, affect their decision. And through my research, I find that investors have a lot of behavioral biases, and these behavioral biases can actually cause them a lot of harm. So how do you avoid, being, how do you avoid falling from prey to your own behavioral bias? I think awareness is the first step. So you need to know about the behavioral bias, and you should always question your decision before you make one. For example, am I buying this stock because I believe in the fundamentals or because everyone else is? So there are some tools such as documenting your trades, setting your investment rules, or you can learn more about finance that can help you bring discipline and objectivity to the process. Which is why I've been stressing, the importance of education programs, especially education programs that highlight some common biases. For example, loss aversion, anchoring, and confirmation bias. They can be very effective. I guess it's also very important for investors to reflect on your emotional triggers. For example, um, recent years we often hear about something about called FOMO, fear of missing out. What that means is that because you're worried that if you don't take action now, you miss out on the opportunity forever. So you always make very impulsive decisions and then overconfidence can also cause you to underestimate risk. So if you have some habits, like you always review your past trades, you then set realistic goals and you diversify a portfolio, you can actually reduce the influence of your own biases gradually. Well, as you can see, I've always been highlighting the importance of education. So, as educators and for regulators, as well as trading platforms, we should make behavioral finance concepts more accessible so that investors understand why they behave in a certain way, and how the way that they behave would affect their decision, so that they can then be better equipped to make more rational choices and to avoid costly mistakes.
With increased retail participation, are there implications for long-term market efficiency, corporate governance, or investment strategies?
Mm, I was advocate for greater retail participation. There is also a correlation between investors' trust as well as and retail participation. So usually, greater retail participation could be a sign that the citizens, the residents in the community are trusting financial markets more. And the reason that we encourage greater retail participation is because, well, that is how capital markets function. We need a well-functioned capital market so that there are flows in the market, and we can then, support the growth of company, thus finally supporting the growth of the economy. And also greater retail participation can also, enhance market efficiency by bringing in diverse perspectives. It also pressures companies to be more transparent and more responsive. Because retail investors, like those in on Reddit forum, they are really vocal. But of course, it can also lead to short-termism because you've got some investment strategies you need to adapt. So you with the greater amount of retail participation, you need to incorporate sentiment analysis and also the understanding of behavioral finance into traditional models. And also beyond this market dynamics, I think retail investors are increasingly influencing corporate governance. Through shareholder activism and proxy voting, they are beginning to take more control and to assert their views on their issues such as executive pay, climate risk, and social responsibility. And I guess this shift is prompting companies to rethink and reimagine how they engage with individual investors. And lastly, from a strategic, um, uh, can you cut that out? Sorry, I have a call. And lastly, from a strategic standpoint, asset managers and financial institutions that they're now integrating retail sentiment data into their models. So, understanding how retail investors react to news, trends, and social media signals is becoming very essential for forecasting market movements. This convergence of behavioral finance and data analytics is reshaping how investment strategies are built and executed.
Professor Zhong, how has your research informed the development of digital finance tools, investor education programs, or policy framework aimed at retail investors?
So I do have like very diverse streams of research. So I would just maybe give you one example. So for example, during COVID-19, I discovered the significant impact of influencers on retail investor and their trading behavior and their financial well-being. So I've written several articles about the potential harm that influencers can do on retail investors. And I think some of my articles attracted the attention of the regulators in Australia. And then I was I participated in some conferences, and eventually, which then the regulator here they published a policy to ban influencers from giving unlicensed financial advice.
Professor, I would like to conclude this episode with one last question.
Hmm.
Looking ahead, what trends do you foresee in retail investing over the next 5 to 10 years,
Hmm.
particularly in emerging markets or new asset classes?
Oh, the future is always exciting, right? So, in terms of what the future would hold for us, well, first, when you talk about the future or the present, no one can avoid talking about AI. So, I do think that AI-driven investing will become mainstream. Retail investors, they are already increasingly using machine learning tools and robo advisors to automate decision making, analyze sentiment, and also personalize their portfolios. So this technology will actually make sophisticated strategies more accessible to everyday investors. I think next, the other trend I will foresee is the rise of ESG and impact investing will continue to accelerate, particularly in emerging markets. The young investors these days, they are always value driven. They want their money to reflect their belief on climate, equity, and governance. So this will actually push companies to be more transparent and more accountable, and it will reshape how investment products are designed and marketed. And I do still think that we will see a surge in community-based investing platforms because we talked about how retail investors have emerged over the last few years. They love social trading. So these community-based investment platforms will allow investors to collaborate, share insights, and or maybe co-invest. So it reflects a shift towards collective intelligence and social validation in financial decision making. So in summary, I think that retail investors more and more they will demand transparency, personalization, and also value aligned products. So in today's world, it's very important for companies, trading apps, or regulators to rethink in the approach that they are engaging with retail investors.
Thank you so much, Professor Angel Zhong, for sharing your invaluable insights into the retail investing revolution. From behavioral trends to digital finance innovations and the broader implications for markets and policy, today's conversation has given us a deep understanding of how retail investors are reshaping the financial landscape. To our listeners, we hope this episode has sparked new ideas and perspectives on the evolving world of investing. Stay tuned for such more thought provoking episodes. Thank you once again, Professor Zhong, for generously sharing your research insights with us today.
Thank you so much for having me.